If you want to see what a real economic warfare looks like in 2026, you honestly shouldn't be looking at a defense contractor.
No, definitely not.
Right. You need to look at the multinational machinery that's out there fighting inflation, dodging these huge federal tax hikes, and navigating sovereign labor strikes, all while modeling the behavioral psychology of millions of consumers in real time.
Yeah, it's a massive undertaking.
It really is. Basically, look at the company selling you a bottle of Coke Zero. So welcome to this deep dive into the Q2 2026 earnings call for Coca-Cola FEMSA. Ticker symbol is KOF. And taking our usual talk tickers analytical approach today, our whole mission is to carve right through the corporate jargon, isolate the underlying data, and evaluate the actual mechanics of how this bottler is defending its margins.
Exactly. We want to pull out the actionable intelligence for you, the retail investor, to figure out if this stock actually justifies its current multiple. Because, the terrain in emerging market consumer goods is just inherently hostile.
Yeah, to put it mildly.
Right. You're dealing with incredibly volatile currencies, totally unpredictable regulatory regimes, and a consumer base that is just highly, highly sensitive to macroeconomic shocks. So operating in that kind of environment, it requires an operational maturity that goes way beyond just, simple brand recognition.
Right. It's not just about slapping a red label on a bottle anymore.
Not at all. It demands really rigorous financial governance and this aggressive defense of actual physical shelf space.
Okay, so let's pull the top level numbers immediately just to establish our baseline here. For the second quarter of 2026, Coca-Cola FEMSA reported a consolidated volume of 1.1 billion unit cases, which represents a 3.5% increase year over year. Total revenues came in at 76.3 billion Mexican pesos, so that's up 4.7%.
Which is solid.
Yeah, solid top line. But here is the kicker. Adjusted EBITDA grew 12.1% to 15 billion pesos, and majority net income hit 6.2 billion pesos. That is a massive 16.9% spike.
Yeah, that net income number is the one that really jumps off the page. Because moving 1.1 billion unit cases, and remember, each case represents 192 U.S. fluid ounces of finished product, that means managing just an astronomical logistical network.
It's an ocean of liquid.
Basically, yeah. So seeing a 16.9% jump in net income on the back of only a 4.7% revenue increase, that immediately isolates the most critical dynamic of this entire quarter, which is their cost structure.
Right. The numbers present this really stark dichotomy. On paper, gross profit margin expanded by 180 basis points, hitting 47.1%. So the financial optics make it look like this totally frictionless operation. But the reality they discussed on the call reveals severe macroeconomic friction.
Oh, absolutely.
We're looking at an operation that's absorbing crippling excise tax increases in Mexico, navigating these substantial spikes in localized freight costs, and managing physical distribution halts because of labor strikes in Argentina. It operates much like a heavy-duty shock absorber system on an off-road vehicle.
That's a great way to picture it, yeah.
The chassis remains completely level for the shareholders, while the suspension underneath is just taking these violent impacts.
And the gross profit data really bears out the efficiency of that shock absorber system. Gross profit increased 8.8% to 35.9 billion pesos, and operating income rose 9.1% to 10.7 billion pesos.
Wait, didn't they have a one-off in there, though?
They did, yeah. So stripping out the 265 million peso insurance claim recovery that they logged in Brazil gives us the true normalized picture. But even adjusting for that one-off event, core operating income still grew 6.4%. So that margin expansion is completely organic.
Okay, but this is where I have to push back a little on management's narrative, because they heavily credited, quote, favorable raw material costs for this margin expansion. Specifically, they were pointing to the pricing of sweeteners and peat resin.
Right.
But then later in the Q&A, the CFO, Gerardo Celaya, admitted that freight expenses in Mexico surged by 20%. And he also explicitly flagged aluminum costs as highly volatile right now because of the geopolitical situation in the Middle East messing with global supply chains.
Which is a major headwind.
Exactly. So claiming favorable input costs while simultaneously acknowledging a 20% spike in shipping and totally chaotic aluminum pricing, that presents a mechanical contradiction to me. A company can't just ignore a 20% jump in logistics and these wild spot market swings in packaging materials and then still expand gross margins by nearly 2 full percentage points without some kind of structural intervention.
No, you're exactly right. They can't. And that structural intervention you're looking for, it's their hedging book.
Okay, break that down for us.
Sure. So the vulnerability of literally any bottler lies in the commodity spot market.
Right.
A sudden spike in global sugar prices or petroleum derivatives, which obviously dictate the cost of TT plastic, that can compress margins in a matter of weeks.
To totally wipe them out.
Exactly. So Coca-Cola FEMSA operates this highly disciplined mechanical hedging strategy to essentially eliminate that exposure. They utilize financial derivatives to lock in forward pricing on all their critical inputs.
So they're just completely bypassing the spot market entirely. Going into this quarter, management disclosed that they had already hedged 96% of their 2026 sugar requirements. 96%.
Wow.
Yeah. And they locked down 98% of their high fructose corn syrup needs. For packaging, they secured 73% of their aluminum and 65% of their PET requirements.
So securing nearly 3/4 of your aluminum needs via forward contracts before the Middle Eastern supply chain disruptions even hit. I mean, that is a massive competitive moat.
It's incredible foresight. Or it's just really strict governance, honestly.
Right. The Treasury Department is effectively insulating the regional operating divisions from all this macro volatility.
Yeah.
So the local managers in Mexico or Brazil, they don't have to adjust their pricing algorithms every single day based on the spot price of bauxite or sugar.
Yeah.
They operate on a fixed cost basis that was established months in advance. Exactly. And it shifts the management focus entirely to market execution rather than, panic-driven price hikes.
Yeah.
The CFO framed this whole strategy around providing certainty to the local operators. And there's actually an additional macroeconomic tailwind that amplified this strategy over the quarter.
Oh, what's that?
Well, Coca-Cola FEMSA generates its revenue in local Latin American currencies, right? Mexican pesos, Brazilian reals, Colombian pesos.
Right, obviously.
However, global commodities like sugar and PE resin are priced in US dollars. And over the reporting period, several of their key operating currencies actually appreciated against the dollar.
Ah, I see where you're going with this. The mechanics of that currency interplay provide this sort of double leverage effect on their margins.
Precisely.
So they locked in the baseline price of the commodities through the derivative contracts, and then subsequently the local fiat they actually used to settle those dollar-denominated contracts gained purchasing power.
Yes. So the cost of goods sold drops simply because of foreign exchange dynamics. It pads that 180 basis point margin expansion even further.
That is wild. I mean, it just reminds you that analyzing a bottler requires evaluating their treasury governance just as closely as their consumer demand.
100%. This predictable cost structure is what allows them to absorb those localized shocks, like that 20% freight increase in Mexico you mentioned, without having to immediately pass that volatility onto the consumer.
Which their competitors can't do.
Right. Smaller, unhedged competitors in those same exact markets are forced to purchase raw materials at spot prices, often with weaker purchasing power. So they're forced to raise retail prices and just bleed market share.
Okay, so margins isolate the efficiency of the corporate machine. But volume is what actually dictates the market penetration. And the consumer demand data from this quarter fractures really neatly into two distinct geographical narratives.
It really is a tale of two geographies right now.
Yeah. You've got the explosive growth engines, and then you have the defensive battlegrounds. So starting with the growth engines, the South American data is heavily weighted by Brazil and Colombia. Brazil volume grew 5.2%. And the stills category, which is, non-carbonated items like teas, sports drinks, and energy drinks, that surged 23%.
Which is huge.
And Colombia delivered a 17.7% volume increase.
Yeah, and a near 18% volume jump in a mature beverage market like Colombia. That indicates a significant macroeconomic catalyst is at play.
Right, it doesn't just happen in a vacuum.
Exactly. Colombia recently implemented a minimum wage increase, and their national unemployment actually dropped to 8% in May, which is the lowest for that specific month in over 2 decades.
Wow, okay.
So this injected immediate liquidity right into the working class consumer base. And in emerging markets, initial waves of disposable income very often flow directly into affordable luxuries and packaged consumer goods.
Makes total sense.
Yeah, and this macro shift really materialized in their flavors segment. So brands like Sprite and the local grapefruit soda Quattro, which saw a 27.2% growth in Colombia.
Okay, but looking at the Brazilian volume growth, that reveals a much deeper, more intentional structural shift in their product portfolio. CEO Ian Craig detailed the execution of what they're calling the Brazil playbook for Coca-Cola Zero.
This is fascinating stuff.
It really is. The zero sugar variant grew 15% in Brazil this quarter, pushing it to a 30% mix of their total portfolio in that country. 30%. And if you contrast that with Mexico, Coke Zero only accounts for 4% of the mix there. Or Guatemala, where it's sitting under 2%.
Yeah, it's night and day.
So the Brazilian market is really operating as the vanguard for this entire portfolio transition.
And the behavioral economics behind this 20% threshold are just absolutely critical to understanding their long-term growth algorithm. Management actually broke down the cannibalization curve of the Coke Zero product lifecycle on the call.
Okay, yeah, explain how that works, because people always assume it just eats into regular Coke sales immediately.
Right, that's the standard assumption,
Yeah.
but it's wrong. During the initial rollout and aggressive marketing phases, Coke Zero does not meaningfully cannibalize the flagship full-sugar Coca-Cola.
Really? So where's the growth coming from?
It captures market share from peripheral categories, competitor juices, flavored waters, and alternative low-calorie beverages. It essentially acts as an acquisition tool for consumers who were previously just totally outside the core Coca-Cola ecosystem.
Ah, I love this. It operates essentially as a Trojan horse.
Yes, exactly.
The zero sugar, zero calorie proposition bypasses the consumer's health-conscious objections, right? And it secures a footprint inside the physical household refrigerator. So it displaces the competitor's product, but more importantly, it locks that household into the Coca-Cola distribution and branding network.
Spot on. The brand loyalty is established via the health-conscious alternative, and the cannibalization of their own flagship product only begins to materialize once that zero sugar variant crosses roughly the 20% portfolio mix threshold.
Okay, so that's the magic number.
Right, so Brazil, currently sitting at 30%, is indeed experiencing that internal cannibalization now. But the strategic calculation totally validates the trade-off. They capture the competitor's market share during the whole run up to 20%, which permanently expanded their total addressable market within those households.
And now management is openly attempting to export this exact life cycle model to Mexico and Colombia to replicate that incremental volume growth.
Exactly. Capturing the market share from rivals before the product starts eating into your own legacy sales is a highly, highly calculated life cycle management strategy.
Okay, so while South America operates as this amazing growth engine, the defensive battlegrounds of Argentina and Mexico present a much harsher reality. Argentina actually contracted by 2.8%.
Yeah, the macroeconomic environment in Argentina remains deeply, deeply distressed. The call noted that consumer demand recovery there is severely lagging expectations.
Which isn't super surprising given the inflation there.
Right. And purchasing behavior is aggressively shifting toward value and affordability. But compounding that crushed consumer sentiment, the regional logistics network was totally paralyzed by a widespread truck driver strike. It literally choked the supply chain physically.
But despite all of that, the strike, the macro conditions, the data shows they still gained 100 basis points of market share in carbonated soft drinks in Argentina.
Which is wild.
Right. How did they pull that off?
They achieved it simply by maintaining superior affordability and distribution resilience compared to the local competitors.
Yeah.
The local guys were just entirely sidelined by the macro conditions.
They just couldn't get their product on the shelves.
Exactly. But the ultimate stress test for this management team, the one that really matters, is Mexico.
Right. Mexican volume registered a microscopic 1% gain. And the operating environment was characterized by this fatigued consumer base and a newly implemented, highly aggressive excise tax increase.
Yeah, that tax hike was brutal.
And the defining strategic decision of the entire earnings call centers on their response to this specific tax hike in Mexico. Management actively chose to pass only 85% of the total tax and inflation-related costs through to the consumer, meaning they deliberately absorbed the remaining 15% hit to their own margins.
Now, failing to pass on 100% of input costs is traditionally flagged as a severe lack of pricing power by Wall Street.
Right, exactly. Isn't that a massive red flag? In an inflationary environment, if a company cannot raise prices to protect its margins, the whole operational model degrades.
You would think so, but the Q&A portion of the call revealed that this was actually not a failure of pricing power at all. It was a tactical deployment of revenue growth management, and it was deeply informed by a historical operational failure. CEO Ian Craig directly cited the fallout from the 2013 and 2014 Mexican tax hikes.
Oh man, the 2013 scenario, that serves as just a perfect textbook study in the limits of consumer elasticity.
It really does.
For our listeners who don't remember, when faced with a similar massive excise tax hike a decade ago, the previous management regime opted for immediate full cost pass-through. They just dumped the whole cost on the consumer.
Yep.
And the resulting sticker shock completely violated the consumer's price threshold. The company hemorrhaged 190 basis points of market share almost instantaneously.
Just brutal.
Greg noted that this single aggressive pricing action triggered a structural decline, resulting in 8 consecutive years of market share erosion in Mexico. 8 years. They didn't even stabilize the bleeding until 2023.
Right, because losing 190 basis points of market share in a volume-heavy, low-margin business like bottling triggers massive operational deleverage.
What does that mean practically?
Well, bottling plants running below capacity still incur all their fixed costs. The machines are still running, the lights are still on.
Yeah.
So that compresses margins even further, initiating this vicious cycle.
Ah, I see.
So applying that historical lesson to the current quarter, management ran their elasticity models and purposefully opted for margin sacrifice. By absorbing that 15% cost deficit and simultaneously pivoting their marketing aggressively toward affordable multi-serve options, specifically the 2-liter returnable PT formats, they altered the consumer response completely.
And the data totally proves the efficacy of that defense, because instead of hemorrhaging share like in 2013, they gained 0.5 points of NARD, that's non-alcoholic ready-to-drink market share, and 0.7 points in the carbonated soft drink category.
They traded transient gross margin for permanent physical shelf space and consumer retention.
Yeah, they engineered what management termed a share cushion. I love that phrase. And this goodwill and entrenched market position provides the leverage required to execute the delayed price hikes that they scheduled for August, which are designed to finally catch up and capture the trailing inflation costs.
Securing the consumer base prior to the price adjustment represents the absolute core tenet of modern revenue growth management. The operational discipline to accept a short-term margin hit to preclude a decade-long share bleed. That demonstrates a management team focused on terminal value over quarterly optics.
Absolutely.
But, defending market share from inflation is only half the equation. Physically capturing that share from competitors at the point of sale requires sophisticated logistical execution.
Right, and the infrastructure driving that market share acquisition relies heavily on their proprietary digital ecosystem, which honestly might be the most fascinating part of this whole story.
It's definitely the most futuristic part.
The operation is anchored by 2 main platforms, Juntos Plus and Juntos Advisor. Let's translate the jargon here. Juntos Plus functions as the B2B e-commerce gateway for the traditional trade sector. And when we say traditional trade, we are talking about the millions of independent mom-and-pop corner stores that form the absolute backbone of Latin American retail.
Yeah, they are everywhere.
So instead of relying on the physical arrival of a route pre-seller to manually inventory the cooler, look at the shelves, and write an order on a clipboard, the store owner interfaces directly with this digital platform to manage their procurement.
And the adoption metrics for Juntos Plus indicate this just rapid digitization of the traditional trade route to market. Digital sales now account for 38% of all traditional trade volume in Mexico.
That's huge.
It translates to 19% of their total consolidated revenues in that territory.
Wow.
Yeah, shifting nearly a fifth of total Mexican revenue through a proprietary algorithmic ordering system fundamentally alters the unit economics of their distribution network. It's incredibly efficient. And in Brazil, the integration of the sister platform, Juntos Advisor, has reached 100% saturation among their pre-sales force.
Okay, so explain Juntos Advisor, because that essentially weaponizes the frontline sales rep with predictive analytics, doesn't it?
Weaponizes is the perfect word for it.
The historical dynamic was a rep walking into a store and negotiating shelf space based on gut intuition and manual stock counts. Hey, looks like you're low on Coke. Let me put a few more bottles here. Now, the rep enters the store, guided by algorithms processing localized demographic data, historical purchase velocity, and even micro-weather patterns.
It's wild. They literally look at the weather.
Right. The platform dictates optimal cooler planograms and suggests specific SKU assortments that are engineered to maximize the average ticket size for that specific neighborhood on that specific day.
And the physical manifestation of this digital strategy is highly, highly measurable. Management reported that the deployment of these tools improved combined cooler coverage in Mexico by 3 full percentage points.
Which might not sound like a lot to a layman, but
in the context of traditional trade, cooler real estate is the most valuable asset in the entire store. Increasing cooler coverage by 3% means systematically evicting competitor products from eye-level, chilled placements across thousands and thousands of independent locations.
And the relationship dynamics with the store owner fundamentally changed, too.
Definitely.
The Coca-Cola FEMSA rep transitions from a vendor who's just pushing inventory to a data-driven consultant, optimizing the store's profitability per square foot. Establishing that level of integration creates an immense structural moat. I mean, think about it. A competitor attempting to reclaim that cooler space is no longer just fighting the Coca-Cola brand. They are fighting an entrenched algorithmic inventory management system that the store owner relies on to make rent.
Exactly. It's a phenomenal defense mechanism. But while the digital logistics locked down the supply side, the demand side this quarter was manipulated through highly opportunistic brand activations.
Yes, the World Cup.
Right. The timing of the FIFA World Cup provided this totally unique macroeconomic catalyst. Management front-loaded their annual marketing expenditure, driving a 9% increase in Q2 marketing spend. And it was specifically calibrated to hijack the cultural momentum of the tournament.
And the localized execution of that budget drove immediate market share capture. In Mexico, they deployed these fan-fest experiential activations, and that directly correlated with their sports drink, Powerade, capturing 150 basis points of market share.
Which is a great win.
It is. But the most sophisticated margin-accretive maneuver occurred in Brazil. And it utilized the cultural phenomenon of Panini World Cup stickers. This blew my mind.
Oh, this was brilliant. The Panini sticker campaign in Brazil is a masterclass in behavioral manipulation for margin expansion.
Walk us through it.
Okay, so collecting and trading these stickers is this entrenched, cross-generational cultural activity in Brazil during the World Cup. Everyone does it. So Coca-Cola FEMSA partnered with Panini to distribute exclusive, highly sought-after stickers.
Cool. Standard promo so far.
Right, but here is the genius part. They structurally restricted their availability exclusively to the 600 milliliter single-serve Coca-Cola bottles.
That is just so smart. They identified a rabid cultural demand and deliberately gated it behind their most profitable SKU.
Exactly. Because selling a 600 milliliter single-serve bottle yields a vastly superior margin profile on a per-ounce basis compared to a 2-liter multi-serve bottle.
Right. You pay a huge premium for the convenience of single-serve.
Yeah. By tying the collectible stickers to the single-serve format, they artificially forced consumer volume away from the value formats and directed it right into the highest margin product on the shelf.
And the data totally confirms the behavioral shift. Single-serve mix in Brazil spiked 2.6 percentage points, reaching 28% of the total regional mix.
Engineering a 2.6 percentage point mix shift into single-serve formats across a market the size of Brazil, that generates massive immediate cash flow. It is a prime example of leveraging ephemeral cultural events to drive structural margin accretion.
Okay, so assessing the historical performance of Q2 provides a really solid foundation, but as an investor, you're buying the future, not the past. Evaluating the asset requires projecting this operational machinery forward. What did management's guidance for 2026 and 2027 tell us about their capital allocation priorities and imminent regulatory threats?
Well, starting with capital allocation, CapEx is projected to hold steady at 7% to 7.5% of total revenues.
Which seems pretty standard.
It is. This run rate sustains their physical infrastructure expansion, which we saw evidenced by the inauguration of the new PET production facility in Costa Rica and the new aluminum can manufacturing line down in Uruguay. But the defensive posture regarding 2027 commodities pricing is what's really impressive. They are already highly advanced on that front.
Right, the Treasury governance that protected Q2 margins is already executing against 2027 volatility.
Exactly. The CFO confirmed they have aggressively layered forward contracts for the upcoming fiscal year. They've secured 80% of their projected sugar and high fructose corn syrup requirements for 2027, along with 54% of their projected aluminum needs.
Well, they are not messing around.
No, they're locking it down. And the balance sheet is also generating excess liquidity, which obviously prompted analyst inquiries regarding capital return strategies. Management indicated a comprehensive review is currently underway, and they're modeling the respective yields of share repurchase programs versus extraordinary dividend distributions.
So they are actively signaling a priority to return capital to shareholders.
Yes, very clearly.
The financial engineering is definitely robust, but the macroeconomic environment in Brazil poses some significant regulatory risks for 2027 that we need to talk about. Management explicitly detailed 2 legislative threats currently advancing through the Brazilian government.
Yeah, these are the dark clouds on the horizon.
The first one involves a restructuring of federal taxes, introducing the potential for selective elevated tax rates that specifically target the beverage sector. The second, and an honestly far more disruptive threat, is a proposed labor journey reform.
That labor journey reform is the real kicker. It targets a fundamental shift in the standard Brazilian 6-day work week.
And why is that such a big deal for them?
Because a bottling operation is inherently a massive, labor-intensive logistics network. Distributing 1.1 billion unit cases requires a highly coordinated army of route drivers, warehouse operators, and merchandisers. Mandating a shortened work week geometrically increases the headcount required just to service the existing distribution routes.
And the macroeconomic context makes this legislative threat incredibly volatile because Brazil is currently operating at full employment.
Right.
If the labor reform passes, Coca-Cola FEMSA cannot simply pull from a vast pool of unemployed labor to fill these newly created shifts. They will be forced into a highly competitive labor market, triggering severe wage inflation as they pay premiums to essentially poach logistics workers from other industries.
It's a potential nightmare scenario. Modeling out a scenario where Brazil implements both the selective beverage tax and the labor journey reform simultaneously. I mean, that forces a critical strategic decision onto the management team.
So the deployment of the Mexico playbook becomes the central question here. If they get hit with massive cost inflation in Brazil next year, do they pass the pain entirely to the Brazilian consumer, or do they absorb the margin compression to defend that 30% Coke Zero market share they fought so hard for?
It's the multi-million-dollar question.
Yeah.
And CEO Ian Craig actually addressed this directly. He stated that the response hinges entirely on the magnitude of the legislation. Minor tax restructurings, those will be systematically passed through.
Okay.
However, he strongly indicated that a massive, disruptive legislative shock would trigger a defensive share protection strategy. They would absolutely sacrifice near-term margins to protect the structural integrity of their market dominance in Brazil.
So tracking the progression of the Brazilian tax and labor legislation is really the primary actionable metric for anyone evaluating this equity heading into 2027. Those legislative outcomes will directly dictate the margin profile of their most critical growth engine. So bringing it all together, the verdict on this quarter, analyzed through our Talk Tickers framework, yields a definitively bullish outlook for the long-term holder.
I agree.
The thesis rests entirely on this demonstrated operational maturity.
Look, an undisciplined management team optimizes for the current quarter. They hike prices to satisfy immediate margin expectations, thereby alienating the consumer base and initiating a long-term erosion of market share. We've seen it 100 times.
Exactly.
But this team
is actively sacrificing localized, short-term margin vanity in Mexico to construct an impenetrable multi-year share cushion. And simultaneously, they are aggressively digitizing the traditional trade network via Juntos Plus to lock out competitors while running these highly sophisticated, margin-accretive marketing arbitrages like the Panini stickers in South America. The immediate operational test arrives in August, though. The listener really must monitor the Q3 volume data coming out of Mexico. Management deferred 15% of those inflation-related price hikes in Q2 to build consumer goodwill, like we discussed. But they are scheduling the remainder of those price adjustments for August.
Right, the bill comes due.
If the Q3 data shows Mexican volume remaining flat or even expanding despite the August price hikes, it completely validates their revenue growth management strategy. It proves the brand loyalty absorbed the pricing action, confirming the integrity of their pricing power and projecting robust future cash flows.
And honestly, the successful execution of those August pricing adjustments would definitively prove that the catastrophic elasticity miscalculations of 2013 have finally been eradicated from the corporate DNA.
Totally agree. Now, as we close the analysis, a peripheral detail from the transcript presented this fascinating macro thesis that I want to leave you with. During the introductory remarks, management casually noted the donation of 100,000 liters of purified water to support earthquake relief operations in Venezuela.
Yeah, I caught that too.
And then later in the Q&A, analysts specifically probed management on their tracking of El Niño weather patterns and regional precipitation models.
Which is highly unusual for a standard earnings call.
Right.
It forces a real reevaluation of the underlying asset base. The standard financial model values a bottler based on brand equity and consumer demand, right?
Right.
However, the physical reality of the operation dictates that they command vast, highly secure water rights across the entire Latin American continent.
And as global climate volatility increases and localized water scarcity becomes a chronic sovereign issue, the infrastructure required to secure, aggressively purify, and physically distribute liquid at a continental scale. That becomes an existential asset.
It really does.
Coca-Cola FEMSA operates a hyper-local, digitally optimized distribution grid capable of delivering potable liquid to the most remote, infrastructure-poor regions of the hemisphere, which was evidenced by their immediate deployment into that Venezuelan disaster zone.
It's incredible logistics.
So, for a long-term allocator modeling out decadal macro risks, it raises a profound structural question for you to mull over. At what point does a multinational beverage bottler transition into a critical proxy for climate-resilient water infrastructure?
It is definitely a complex valuation paradigm to consider before the next earnings cycle.
Keep your eyes on the data.